Great money managers are like the rock stars of the financial world. The greatest investors have all made a fortune off of their success, and in many cases, they've helped millions of others achieve similar returns. These investors differ widely in the strategies and philosophies they applied to their trading. Some came up with new and innovative ways to analyze their investments, while others picked securities almost entirely by instinct. Where these investors don't differ is in their ability to consistently beat the market. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 10. Carl Icahn. Carl Icahn is a combative investor and activist who utilizes his ownership stakes in publicly traded firms to compel reforms that would raise the value of his shares. Icahn began actively engaging in corporate espionage in the late 1970s, and with his hostile acquisition of TWA in 1985, he entered the major leagues. The Icahn Lift is Icahn's most well-known project. The upward surge in a firm's stock price that generally occurs when Carl Icahn starts purchasing the shares of a company he thinks is mismanaged as described by this Wall Street idiom. Number 9. Jack Bogle. In 1975, Bogle launched the Vanguard Group mutual fund firm, which he grew into one of the biggest and most reputable fund sponsors in the world. For millions of investors, Bogle was a champion of no-load mutual funds and low-cost index investing. In 1976, he developed and released the first index fund, the Vanguard 500. Jack Bogle's approach to investing encourages buying no-load, low-cost, low-turnover, passively managed broad-based index mutual funds in order to profit from market gains. Number 8. Warren Buffett. Warren Buffett, sometimes known as the Oracle of Omaha, is regarded as one of the greatest investors in history. He has built a multi-billion-dollar fortune by adhering to Benjamin Graham's investing ideas, mostly through acquiring stocks and businesses through Berkshire Hathaway. Today, those who put $10,000 into Berkshire Hathaway in 1965 have more than $165 million. Buffett's value-oriented, patient, and methodical investment approach has regularly beaten the market for years. Number 7. George Soros. George Soros was an expert at converting general economic patterns into highly leveraged, winning bets on bonds and currencies. When it came to investing, Soros was a short-term speculator who placed big wagers on the course of the financial markets. George Soros established the hedge fund firm Soros Fund Management in 1973, which later developed into the well-known and reputable Quantum Fund. He managed this aggressive and prosperous hedge fund for about 20 years, generating profits that apparently exceeded 30% annually and, on 2 instances, exceeded 100%. Number 6. Peter Lynch. From 1977 through 1990, Peter Lynch oversaw the management of the Fidelity Magellan Fund, which saw its assets increase from $18 million to $14 billion. The fact that Lynch apparently outperformed the S&P 500 index benchmark in 11 of those 13 years, achieving an average return of 29% annually, is more significant. Peter Lynch, who was sometimes called a chameleon, adapted to whichever method of investing was successful at the moment. However, when it came to selecting particular equities, Peter Lynch stuck to what he was familiar with and/or could comprehend. Number 5. Jesse Livermore. Jesse Livermore lacked a formal education and no past experience in stock trading. He was a self-made guy who gained knowledge from both his successes and failures. These trade-related achievements and disappointments served to solidify concepts that are still prevalent in the market today. By the time Livermore was 16, he had allegedly made gains of over $1,000, which was a significant sum of money in those days. Livermore started trading for himself in his early teens. He gained money during the ensuing years by placing bets against so-called bucket shops, which didn't process real deals and allowed consumers to wager against the house on changes in stock prices. Number 4. Neff. Neff started work for Wellington Management Company in 1964 and managed 3 of the company's funds throughout his more than 30 years there. He was regarded as a value investor since he chose to invest in well-known sectors indirectly and concentrated on businesses with low P/E ratios and high dividend yields. He managed the Windsor Fund for 31 years, ending in 1995, and during that time, it generated returns of 13.7% compared to the S&P 500's 10.6%. This is an increase of more than 53 times the original investment from 1964. Number 3. Thomas Rowe Price Jr. The father of growth investment, according to Thomas Rowe Price Jr. He struggled through the Depression during his early years, and the lesson he took away was to embrace stocks rather than to avoid them. Financial markets, in Price's opinion, are cyclical. He started investing in good firms for the long term, which was practically unheard of at the time, in order to stand out from the throng. According to his investment philosophies, long-term investors should concentrate more on choosing individual stocks. He built his successful investment career on a foundation of discipline, method, consistency, and basic research. Number 2. John Templeton. John Templeton, one of the greatest contrarians of the 20th century, is credited with making several profitable decisions between buying cheap during the Great Depression and selling high during the Internet boom. Some of the biggest and most prosperous worldwide investment funds were founded by Templeton. In 1992, he sold the Franklin Group the Templeton assets he had. He was dubbed, probably the best worldwide stock picker of the century, by Money magazine in 1999. Templeton, a naturalized British citizen who lived in the Bahamas, received a knighthood from Queen Elizabeth II in recognition of his numerous achievements. Number 1. Benjamin Graham. As a financial instructor and investment manager, Ben Graham was exceptional. Among his other writings are two financial classics of incomparable significance. Security analysis and value investing, two essential investment disciplines, are both widely regarded as having been invented by him. Any investment should be worth significantly more than what an investor has to pay for it, according to the core principle of Graham's value investing. He was a proponent of basic research and looked for businesses with solid balance sheets, little debt, higher than average profit margins, and significant cash flow. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.